Hi guys, welcome to your own show MKJ Talks for Investment in English. In today's episode, we are going to discuss one of the most important tool of fundamental analysis, and that is, I think you have guessed it, that is price earning ratio. You know, top financial analysts, top financial advisors, they all say price earning ratio is key to success in stock market. According to them, all decisions of investing or disinvesting in stock market is taken on the basis of price earning ratio. So now the $1 million question is, what is price earning ratio? As the name itself suggests, price earning, it suggests price upon earning. When you divide market price of share with earning per share, you get price earning ratio. And price earning ratio is popularly known as PE ratio. So by dividing market price of a share with earning per share, you get price earning ratio, and on the basis of price earning ratio, you take decision whether to invest in a particular stock or to disinvest in that particular stock. So today friends, I will tell you how this price earning ratio is calculated. I will tell you everything in great detail. Now let us refer to the screenshot on your screen, which is showing profit and loss statement of a company with the help of which we will be able to calculate price earning ratio. And after watching this video, you will be able to understand how to read profit and loss statement as displayed on most of the investor friendly websites. For example, on Money Control. Then after watching this video, you will be able to understand the screens of profit and loss statement given on moneycontrol.com. Hopefully this video will help you a lot. Now let us discuss. At the top you can see we have particulars and amount in crores. The first item is income. Income is nothing but source of revenue for a company. From its revenue or income, company deducts all its expenses related to business and arrive at a figure which is popularly called profit and loss before interest, exceptional and extraordinary items. In our illustration, income of the company is 100 crores. From 100 crores, company has deducted 60 crores which are its expenses, and profit and loss before interest, exceptional and extraordinary item is 40. Now from this 40 the company has deducted, we have deducted interest of 5 crores and we obtained a figure which is profit and loss before exceptional and extraordinary item which is 35. We either have written profit oblique loss, or I have written P oblique L. P oblique L is nothing but profit oblique loss, or you can call it profit and loss. If the figure is positive, then it means it is profit, and if the figure is negative, then it means it is loss. I am telling you the very basics so that those of you who are not of commerce background, they are also able to understand each and every step related to calculation of price earning ratio. Now in our example, from profit and loss before exceptional and extraordinary item of 35 crores, we have added exceptional item. In this case the company has earned some exceptional profit of 8 crores. So it gets profit before tax of 43 crores. From this 43 crores, company has deducted total tax expenses which is 10 crores. So profit and loss after tax before extraordinary item is 33 crores. On many sites you will see that tax expense has been divided into 2 or 3 subheads: current tax, MAT credit, deferred tax. So I have given single figure, they might give you 3 figures and total of those 3 figures. To simplify and make things easy for you, I have just written tax expense. I think you have understood my point. Now if there is some extraordinary gain or loss, you will deduct to arrive at the figure which is known as profit and loss for the year. In our case, there is no extraordinary item. So our profit and loss for the year is a profit of 33 crores. So this is how we calculate total earning of the company. Now we will divide this total earning of the company with total number of equity shares. In our case, number of shares of the company are 2 crores. So on 2 crore shares, the company has earned a profit of 33 crores. Now, if you divide earning of 33 crores by 2 crores, you will get earning per share. What company has earned on one share? So, on 2 crores, the company has earned 33 crores. So, 33 divided by 2 gives you 16 rupees 50 paisa. This figure is not in crores. You may write this figure is not in crores. 16 rupees 50 paisa is in rupees. Rest of the figures are in crores. Have you understood? So, earning on one share is 16 rupees 50 paisa. Market price per share, this figure 200 is also not in crores. So, last second, I mean EPS and MPS are in rupees. Rest of the figures are in rupees crore. I mean, you have understood the concept. So, on one share, the company has earned 16 rupees 50 paisa and the price of the share in the market is 200. Now, if you divide 200 by 16 rupees 50 paisa, you get price earning ratio of 12.12. I think now you have earned. The price of the share under discussion is 200 rupees. This share is being quoted in the market or traded in the market for 200 rupees and this share has an earning per share of 16 rupees 50 paisa. So, if we divide market price of 200 with 16 rupees 50 paisa, we get price earning ratio of 12.12. Now, how to decide on the basis of whether to purchase a share or sell a share? There is a very simple rule, although there is a catch in the rule, but I will try to explain you both the aspects. It is agreed amongst all the investors that price earning ratio normally in an economy, and normally if you talk of price earning ratio of a particular index, say Nifty 50, it varies from 10 to 15 at the lower side and 30 to 35 on the higher side. At any point of time, if you want to know what is the price of the Nifty index, it should be on the lower side, it should be somewhere between 10 to 15 and on the upper side, it should be somewhere around 30. And you can always find out price earning of Nifty index just on Google. You type PE NSE. PE means price earning ratio, NSE Nifty. Just type PE NSE Nifty. Yeah, PE of Nifty NSE. NSE is National Stock Exchange. You will get the link and when you will click on the link, it will give you the price earning ratio. So, this is very easy to find out. I mean, it is very easy to find out pre-calculated price earning ratio at any point of time by visiting NSE, that is National Stock Exchange website. I think you have understood. So, now what is the thumb rule? The thumb rule is most of the big investors, most of the business, stock exchange tycoons, share tycoons, they say whenever you see that the market index, or in our case it is Nifty index, has a PE near its lower side, near 10 to 15 times, it is the time to buy shares. And whenever it is on the higher side, say around 30, it is time to sell the shares. So, this is the thumb rule. So, you can always very easily decide whether to buy shares or sell shares. If you find PE ratio to be very high, it is time to sell. If PE ratio is very low, it is time to purchase. But there is a small catch in it. As a retail investor, we can always know, or we can only determine what is the current price earning ratio. That is price earning ratio based on company's latest financial reports, company's latest financial information. But we cannot find out as a retail investor projected PE, that is price earning ratio based on expected earning. In my example, you remember I found out profit and loss for the year. If this profit and loss for the year is on the basis of report given by the company, then it becomes historical. Then it becomes current price earning, and on the basis of that earning, you get a current price earning ratio. But if you make a projection of this profit and loss by putting in projected income, projected expense, projected interest, projected tax, if you can project for the future, then the EPS which you will get will be projected EPS. And if you divide market price per share with projected EPS, you get projected price earning ratio. So the shrewd investors or big investors, they have lot of R&D staff with them, research and development staff with them, which have been trained to work out and find out what will be the projected earnings of different companies. Projected earning means future expected earnings of different companies. On the basis of that, they find out projected PE, and on the basis of this projected PE, they decide whether to sell or buy shares at present. So sometimes retail investors are bound to commit mistake. I'll give you an example. Suppose at present you go to NSE site and you see that current price earning ratio is 30. You will feel that I should sell the share. Why? Because everybody says when PE ratio is on the higher side, near 30, you should sell the share. This will be your decision as a retail investor. But now here there is a catch. Look, this PE is on the basis of current earnings. Now double investors in the market, they are doing lot of research and they have obtained the information that next year the earnings of companies will rise and will get doubled. So next year, a present earning is suppose 10, next year earning will be 20. This means you will be dividing current market price with double current EPS, and if you will divide it by double current EPS, your price earning ratio will get halved. So on the basis of current earning, if you are getting 30 as PE ratio, then on the basis of projected earning, it should be 15. So as a retail investor, you will be committing mistake by selling the shares in the market. Why? Because you are unaware of the projected EPS, you are aware of the current EPS, and at that point of time, the big investors, they are aware that projected EPS is 15, next year company's earning will rise, this price earning ratio will get reduced, then it will become very attractive and its price will rise, so they will purchase the shares. This way sometimes retail investors incur lot of mistakes, or you say they take wrong decisions because they are taking their decisions on the basis of historical or current price earning ratio, but correct decision is always taken on the basis of projected price earning ratio. I think now you have understood each and every aspect of the most important tool of fundamental analysis, that is PE ratio, and you have well understood what is PE ratio, how it is calculated, what is current PE ratio, what is projected PE ratio. Current PE ratio can be easily obtained, projected PE ratio is based on research done by various people, it is on the basis of expected future profit. Correct decision will always be on the basis of projected PE ratio. Decisions based on current PE ratio can be wrong. So this was the summary of my entire lecture of today. Hopefully you have understood each and every aspect of price earning ratio. Now if you have liked my video, please press the like button, share this video with your friend, and subscribe to my channel. As if you subscribe to my channel, you will get instant notification of my new videos. But for your information, daily I come up with a video in English at 3 p.m. and in Hindi at 7 p.m. With this, I wish you bye-bye. Remember to subscribe to my Telegram channel. On that channel, I give various information on real-time basis regarding IPO and various news items which I cannot cover instantly on my YouTube account. So it is very important for you to subscribe to my Telegram channel. Its link is given in the description box. So with this, my final bye-bye. God bless you.